Something just happened in the silver market that has only occurred one other time in the entire post-World War II era, one single time in more than 8 decades of modern financial history, and almost nobody on mainstream financial television is explaining why this signal matters or what happened the last time it appeared. Because if they did, if they honestly walked investors through the historical parallel, it would create a level of urgency around precious metals ownership that many banks and brokerage firms would rather avoid. Right now, 1 ounce of silver is worth more than 1 barrel of crude oil. Let me repeat that slowly because this ratio is incredibly important. On a monthly average basis, the price of a single troy ounce of silver has just moved above the price of 1 barrel of crude oil, and that has only happened twice since the end of World War II. The first time was January 1980, that was during the Iranian hostage crisis, the Soviet invasion of Afghanistan, and the famous Hunt brothers' attempt to corner the global silver market. It was a moment when inflation was spiraling, geopolitical tensions were exploding, and confidence in fiat currencies was collapsing. And now, in March 2026, the signal is flashing again. Silver is trading close to $90 per ounce, while crude oil just crashed from around $120 to roughly $80 per barrel in less than 2 days. That dramatic move happened immediately after Donald Trump appeared on CBS and suggested that the week-long bombing campaign against Iran was very complete and essentially over. The oil market believed him. Crude prices collapsed almost instantly, but silver did something very different. Silver actually rallied nearly 5%, while oil was falling. And that divergence, that sudden separation between the world's most important industrial commodity and one of the oldest monetary metals is sending a signal that many analysts are completely missing. Before we go any further, I want you to drop a comment and tell me where you're watching from. What city, what country, what time zone? Every time I ask this question, the responses remind me of something important. The precious metals story is no longer just a Western investment trend. It is becoming a global conversation happening simultaneously across North America, Europe, Asia, and the Middle East. Now let's talk about why this silver-oil ratio matters so much. Oil is the lifeblood of the modern industrial economy. It powers transportation, agriculture, global supply chains, and military logistics. When oil is expensive relative to precious metals, it usually signals strong economic growth and high industrial demand. But when silver becomes more valuable than oil, something deeper is happening. It means markets are shifting their focus away from consumption and toward preservation of wealth. In simple terms, investors begin valuing monetary protection more than industrial expansion. That is exactly what happened in 1980. Back then, the US dollar was under enormous pressure from double-digit inflation. The Federal Reserve was struggling to control prices, and geopolitical tensions across the Middle East and Central Asia were creating extreme uncertainty in global markets. Silver surpassing oil was the marketist way of saying that confidence in the financial system itself was beginning to crack. Today, the backdrop may be even more extreme. U.S. national debt has exploded past $40 trillion. Budget deficits are running near historic levels, and central banks around the world are trapped between inflation on one side and economic slowdown on the other. At the same time, geopolitical risk is rising again. The recent military escalation involving Iran pushed energy markets into chaos, briefly sending oil to multi-year highs before the sudden collapse that followed Trump's televised remarks. Yet even as oil prices fell, precious metals refused to follow. That resilience is not random. It reflects growing demand for assets that cannot be printed, diluted, or politically manipulated, and gold is already demonstrating just how unstable the current market environment has become. In the first 9 weeks of 2026 alone, gold has experienced 17 single-day moves of more than $100 per ounce. Before this year, that had happened only 14 times in the entire modern trading history of gold. In other words, the volatility we are seeing now is unprecedented. And when markets start moving like this, it usually means the financial system is entering a completely different phase, one where traditional assumptions about stability no longer apply. Silver mining projects take years to develop. New exploration has to be approved, infrastructure has to be built, environmental permits have to be issued, and billions of dollars in capital must be committed before a single new ounce reaches the market. In other words, supply cannot respond quickly to sudden surges in demand, and that is exactly what makes the current setup so unusual. For years, the global silver market has quietly operated in deficit. Industrial demand has been steadily rising while new mine supply has struggled to keep pace. Most investors never noticed this imbalance because the paper derivatives market was able to absorb the pressure and keep prices relatively stable. But when physical demand begins to exceed the ability of the paper market to suppress it, the entire pricing structure can change very quickly. This is where the physical exchanges begin to matter. In recent months, analysts tracking the physical market in Asia have noticed something remarkable. The premium for physical silver on the Shanghai market has been trading significantly above Western futures prices. That divergence suggests that actual buyers of metal are willing to pay more than what the paper market currently reflects. Whenever that gap appears and persists, it usually indicates tightening supply conditions. And historically, when physical premiums begin rising while futures prices lag behind, the futures market eventually has to catch up. This dynamic has appeared before in other commodity markets, but in silver it can be particularly explosive because the overall market size is relatively small compared to assets like crude oil or government bonds. Even modest flows of institutional capital can move the price dramatically. Now combine that structural tightness with the macroeconomic environment we are entering. Global debt levels continue to expand. Central banks are increasingly cautious about tightening monetary policy too aggressively, and geopolitical tensions remain elevated across multiple regions at the same time. When you put those factors together, investors begin searching for assets that are not directly tied to the credibility of any single government or currency system. Historically, that search leads to gold first. But once gold begins moving, silver often becomes the next destination for capital flows because it offers similar monetary characteristics with far greater volatility, and volatility, for many investors and funds, represents opportunity. A relatively small reallocation of capital from global equities or bonds into the silver market could create enormous price pressure simply because the market is not large enough to absorb that capital smoothly. Think about it this way. The global stock market is measured in tens of trillions of dollars. The silver market, by comparison, is only a tiny fraction of that size. If even a small percentage of global investment portfolios begin increasing their allocation to physical metals, the price impact could be disproportionately large. This is why experienced commodity traders watch ratio signals like the silver-to-oil relationship so closely. Those signals often appear early in major macroeconomic transitions. They act almost like warning lights on the dashboard of the global financial system. Most people ignore them because they seem abstract or technical, but historically, when those signals appear during periods of geopolitical stress and monetary instability, they tend to precede major market shifts. That does not mean prices will move in a straight line upward. Markets never behave that way. There will be corrections, sharp pullbacks, and periods where sentiment suddenly turns pessimistic again. But if the structural factors driving the current trend remain in place, those pullbacks may simply represent pauses within a much larger cycle. And that brings us back to the critical level that traders are watching right now. The $90 threshold. Round numbers in financial markets often act as psychological barriers because they attract attention from both human traders and algorithmic systems. When prices approach those levels, liquidity tends to concentrate around them. Orders cluster just above and just below the number. Stop losses, breakout orders, and momentum signals all converge at the same point. So when the level finally breaks with enough volume, the reaction can be surprisingly fast. Short sellers who were betting on resistance suddenly have to buy back their positions. Momentum traders enter new positions expecting further upside, and algorithms programmed to follow breakout patterns begin executing automated buying strategies. All of those forces combined can produce the kind of rapid price expansion that commodity markets occasionally experience. The key question now is whether the current consolidation phase represents preparation for that kind of move or simply a temporary pause before another wave of volatility. No one can answer that question with certainty. But what we can do is observe the signals that the market itself is generating. The silver-to-oil ratio has reached a level not seen since the late 1970s. Gold volatility is reaching historic extremes. Physical market premiums are appearing in Asia, and geopolitical uncertainty continues to influence energy markets almost daily. Each of those signals individually might not mean much, but when they appear together at the same time, they begin to form a pattern. A pattern that suggests the global financial system may be entering a period of adjustment after decades of relatively stable monetary conditions. Whether that adjustment unfolds slowly over many years or accelerates rapidly during a series of financial shocks remains to be seen. But one thing history has demonstrated repeatedly is that hard assets tend to play a significant role whenever monetary systems face periods of stress. And that is why so many investors, institutions, and even central banks continue paying attention to markets like gold and silver, not because they expect the world to collapse tomorrow, but because they understand that financial systems move in cycles, and certain assets tend to perform differently depending on which phase of that cycle the world is currently entering. Right now, the signals coming from the metals market are suggesting that we may be approaching a transition. Whether that transition becomes a historic bull market or simply a temporary spike will depend on how the economic, political, and monetary forces of the next few years ultimately unfold. But the fact that silver is once again challenging a ratio that has appeared only once in the last 80 years should at least encourage investors to pay attention. Because sometimes the most important signals in markets are the ones that appear quietly before the majority of participants fully understand what they are seeing. If you found this breakdown useful, consider subscribing so you do not miss the next update as these developments continue to unfold, and I am genuinely curious about your perspective. Do you think silver breaking above oil again is a temporary anomaly? Or could it be the early signal of a much larger shift in the global financial system? Let me know in the comments below.